Oil volatility. You can't print barrels. Flint West reporting. When policy meets physics in the energy market. Section 1. Most people look at oil volatility and see noise. A bunch of traders smashing buttons, algorithms chasing headlines, fear, greed, speculation. And most of the time, they're right. But every now and then, volatility stops being noise. It becomes information. Information about stress, information about constraints, information about a physical system that's beginning to crack under pressure. And that's exactly what the 2026 Hormuz crisis showed us. Because at the center of this entire discussion sits a simple distinction that most people miss. Financial systems move at the speed of information. Physical systems move at the speed of infrastructure. Markets can reprice in seconds. Oil cannot. A trader can click a mouse. A tanker still has to sail. A refinery still has to refine. A pipeline still has to transport. A storage tank still has to store. Physics still has to do physics. And when the Strait of Hormuz became disrupted, the market suddenly found itself trying to price a problem that could not be solved with a Bloomberg terminal. Section 2. The evidence was visible almost immediately. The CBOE Crude Oil Volatility Index, the OVX, had spent much of 2025 drifting around the 30 to 40 range. Nothing unusual. Nothing dramatic. Then the crisis hit. OVX exploded above 120. That wasn't a normal volatility spike. That was the market staring into a range of possible outcomes so wide that nobody knew how to price it. And here's the important part. That volatility wasn't just describing trader emotions. It was describing uncertainty surrounding a physical system responsible for a meaningful share of global oil flows. Volatility had stopped being noise. Volatility had become information. Now, governments didn't sit around doing nothing. Quite the opposite. The United States and its allies deployed some of the largest coordinated strategic petroleum reserve releases in modern history. The objective was obvious: reduce panic, stabilize prices, buy time, prevent contagion. And to be fair, it worked. Oil prices came down, OVX collapsed from panic levels, shipping activity began to improve, confidence returned. Markets started breathing again. From a financial perspective, the intervention looked like a success. But here's where things get interesting. There's a difference between solving a problem and postponing a problem, and markets confuse the two all the time. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 3. Strategic petroleum reserves are not oil production. They're stored oil. That's a completely different thing. Every barrel released today is one less barrel available tomorrow. The charts tell the story. For decades, the United States built up its strategic petroleum reserve. Eventually, inventories exceeded 700 million barrels. That stockpile represented optionality, resilience, emergency capacity. Then the drawdowns began. And during the crisis, those drawdowns accelerated. The same thing happened globally. Strategic reserves did exactly what they were designed to do. They absorbed the shock. But they absorbed the shock by consuming resilience. That's the trade. That's the hidden cost. And that's why the title matters. You can't print barrels. You can print money. You can print credit. You can print confidence. You cannot print oil. You can only consume oil that already exists. And that brings us to the most important question in this entire discussion. Section 4. Once the reserves have been released, once volatility has collapsed, once the headlines have moved on, has the underlying bottleneck actually been solved? That's the question. Because volatility measures uncertainty. It does not measure repair. Prices can fall long before physical conditions normalize. A diplomatic agreement can reduce fear. A reserve release can reduce scarcity. A policy announcement can reduce panic. But none of those things automatically rebuild inventories. None of them automatically restore resilience. None of them automatically replenish depleted reserves. And none of them create new barrels. Section 5. Which means something very strange can happen. The market can be right in the short term and wrong in the long term at exactly the same time. The short-term decline reflects policy. The longer-term risk reflects physics. Those are two completely different mechanisms operating on two completely different timelines. And that's why this framework matters far beyond oil. The same logic applies to power grids. shipping networks, critical minerals, water systems, supply chains, any system where financial expectations eventually collide with physical reality. Section 6. Policy can buy time. Sometimes that's enough, sometimes it isn't. But the mistake is assuming that a reduction in volatility means the underlying constraint has disappeared. Often, it simply means the market has stopped looking at it. So what's the lesson? The lesson is that financial markets are extraordinary machines for distributing information. Governments are extraordinary machines for buying time. Neither can manufacture physical supply. And when a genuine bottleneck emerges, volatility becomes something more than a number on a screen. It becomes a signal that the real economy is under stress. The market may calm, prices may fall, confidence may return. But if the underlying constraint remains unresolved, physics eventually reasserts itself. Because at the end of the day, you can print money, you can release reserves, you can negotiate deals, but you cannot print barrels. Flint West signing off.